Welcome to Thought Leaders, featuring interviews with some of the best minds in the industry. Today's special guest is certified financial planner and registered investment advisor, Rob O'Dell. Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. In this segment, we're talking about charitable giving with pooled income funds, all from Rob's popular Mind Map seminar series. Well, when I think of pooled income, of all the things you talked about this week, this is the most, I think, exciting and yet seems to me a little bit complicated. Maybe you can help us kind of demystify it.
Yeah, it is complicated, no doubt about that, but this is something that was signed into law at the same time the charitable remainder was in 1969. It was charities would set these pooled income funds up traditionally, and people would give cash assets to them in exchange for income. But it's based on what was being earned by the investments. So if they're making 6% income, they were getting paid 6% as their income coming out to them. But in 2004, with some Treasury regulations that's changed, they incorporated what's called a total return pooled income fund, which included capital gain as part of the income factoring. So now they become much more attractive, and now that we're in a low interest environment, the income tax deductions are quite impressive. You know, we talked last segment about the charitable remainder trust, and I said near the end was that it's really for people 60 and over, which is true. However, for people in their 50s, 40s, 30s, and they have low basis stock and they need income tax deductions because they're in peak earning years, this might be something that you look at because of the income tax ramifications that can happen here.
Now, this is new because all this week we've been talking about it. Most of the time I keep hearing, well, the age barrier here is 60 and up. And now you're saying, wow, we could be down in the millennial generation because they may need some tax issues to offset, and they're already benevolently or charitably inclined.
Right. So what this slide right here does is it compares the income tax deduction by age category here. So let's just pick on a 60-year-old. If they do a 6% charitable remainder trust, and they're 60 years old, they'll get income tax deduction right around the 30%. The pooled income fund, will give them double that, or more than double that. And so, but what's really neat is about the charitable remainder trust, they have a rule saying you have to have at least a 10% income tax deduction. So people 35 and under, they're not even eligible for a charitable remainder trust. Whereas with the pooled income fund, they get sizable income tax deductions by gifts made to a pooled income fund.
It looks like also, though, in the retirement age, the whole senior section here, this is huge numbers here.
Correct. Now, another advantage to this over a charitable remainder trust is that you can have two generations be income beneficiaries. So right now I'm working with a client down in Florida, and they're in their mid-80s. They have children in their mid-50s. And if we did a charitable remainder trust, if we put the children on, the income tax deduction would go down greatly. Here, we can put the children on, and mom and dad 80s, children are on, so that when mom and dad are gone, the income continues to move on to the next generation. I really like that. It's one of the nice features about it. So another advantage of this over a charitable remainder trust is the amount of income. If I did a charitable remainder trust at 6%, the maximum I'm going to take out in that tax year is 6%. Not if I earned, let's say I earned 10% in there, but 6% is the maximum I'm going to get out of there. Now, the trust will go up in value, and I'll get incrementally more the next year. In the pooled income fund, if I earn 10%, I will take out 10% as a distribution. Will go out to the income beneficiaries. So there's some distinct advantages for them. We like to look at it as kind of like a charitable remainder mutual fund, or a charitable mutual fund. It's often what it looks like. The income tax deduction rules that we've talked about in the last couple programs all apply to the pooled income fund. There's also, in getting real deep into the weeds, there's opportunities in which you can give things to a pooled income fund, debt encumbered property, as which you cannot give to a charitable remainder trust. So there's opportunities to give a wider range of assets to it, and allows us as planners to do more creative planning for our clients.
Now, when you say, just a little side note, when you say assets that you would not normally be able to do, and you can do with this,
you can do it here.
Give me an example.
Debt encumbered property. Whereas a charitable remainder trust, because it's governed under private foundation rules, this you could do. There's other assets that you can give your royalties. Charitable remainder trust, that's problematic. So it gives us a greater opportunity. Plus it allows us, often as advisors, we get the phone call and the client already signed the letter of intent to sell their business that was binding. You can't give that property, you cannot do any planning with that. And they're going to take a big tax hit. Well, this can help clean up some of the tax hit, or at least take a little bit of the sting out.
That's an interesting thought, because if I went ahead and I already did my deal, selling my business and all this, and I'm like, oh my gosh, I can't believe I just did this from a tax point of view, this could be a way to mitigate some of that.
Correct. Very good way to do that and get some money back. Before we end this segment, I just want to give the diagram here that how it's laid out. A charitable organization is the sponsoring entity for this. The National Community Foundation, for this example I'm using here, outstanding group of people, I think very highly of them and what they're doing here. Here's an example. Here we got Dan and Sally Smith, age 70 and 60. They donate $1 million of stock or real estate with a basis of $250,000. In this case, it's stock. It goes into their pooled income fund. They're going to receive an income tax deduction of $750,000. If this was a 7% charitable remainder unit trust, it'd be closer to about a $300,000 income tax deduction. So they're getting $450,000 more deductibility, which is over $150,000 in tax savings for doing this.
In prior shows, you talked about 50% of the AGI, and yet the deduction is higher than that.
Correct. Well, the deduction is $750,000. So if they have, let's call it $500,000 of income, they can only deduct 30%. So they'd use $150,000 of that deduction. And carry forward 5 years. And if they don't use it all, that's where we as planner come back and say, let's generate some income for you to get deductions. Now, another key distinguishing factor here is that they will get the income as it's earned by the portfolio, by whatever that underlying investment is, they will get the income quarterly for the rest of their lives. So in the example of the charitable remainder trust, if it's 7%, they'll get a 7% unit trust payment. If this makes less than 7%, too bad. They're going to get something less than 7%. However, if they have a total return of greater than 7%, they will get 7%, that greater total on a quarterly basis. Upon the second death, it can go to a donor advised fund that their family members can advise on where the monies go. But conceptually, this is it. Very attractive. It's more for your higher end person. This is not your rank and file. You're probably looking at entry, probably somewhere in the name of $1 million gift to do this, to really make the economics work.
Wow. Well, for more information on charitable giving with pooled income funds, just click on the landing page address in the video description. We'll be right back with more from Rob Odell on pooled income funds in a moment.
This is your website. Few people visit, and if it isn't attracting new visitors, it's not doing its job. Now you can drive more visitors to your website through dynamic content and email marketing with CreativeOne's Social Media Elite. Capture quality leads faster and easier. Engage your visitors with informative articles and videos to boost your online credibility. Plus, stay connected with existing clients and earn more referrals. All content is customized for you. It's time to introduce your website to the world. Call your CreativeOne sales team at 800-992-2642 or visit us online at creativeone.com.
In this segment, we're continuing our discussions on charitable giving with pooled income funds, all from Rob's popular Mind Maps seminar series. And I have to tell you, I've really enjoyed using the PDF format as well as the mind map format. Yeah. It really has a lot of pivoting areas, and I like the visuals for our audience. Now, when I'm thinking of pooled income funds, I want to be able to look at the ability of, this isn't just an end of the year. It could be, but this is.
It'd be very difficult to set this up for a 2015 function.
So really, for most people that are going to see this will be a tactic for 2016.
2016, okay. Correct. And this is more for a higher capacity person. Someone who's going to sell a business, someone who has high income. The person I'm designing a case right now, his income is $3 million, net worth is $60 million, and he needs income tax deductions now before he sells his business. And when he sells his business, but especially now because he's high income and he needs income in the future. So those are the type of people we're looking at, maybe 2 to 3 million net worth and above to start considering this.
Now, from a scholar point of view, none of this is in the gray area of the IRS.
Not at all.
Okay, so this is very straightforward planning.
Sign in law, 1969. Okay. This stuff is pretty straightforward. You see what you get here.
Okay, continue then.
So in this case, we have a gentleman 70 years old, wife 60 years old. They get a high income tax deduction. They get income as it's earned by the portfolio on a quarterly basis. When they die, whatever's in there goes to a donor advised fund. And we talked about last time was, why would someone do this? Well, simply one of the major advantage of a pooled income fund is that they're also governed by the AFR rate of 1.2%. And that's the rate that the government says is what is a reasonable rate of return. Well, if it's that low, that's going to boost up the charitable income tax deductions that are given. So if you look at the charitable deductions for a 1 life starting at age 50 and a 2 life starting at age 50, it is double, in some cases triple, that of a charitable remainder trust or a charitable gift annuity or a grantor charitable lead annuity trust. So this is something from an income tax perspective. If you have someone who's made millions of dollars of options exercised because they had to do it, charitably inclined, this is the type of entity we would look for that.
Well, with a low AFR rate of 1.2%, most decent money managers are going to be able to perform, and you're telling me that their performance above the line of 1.2 actually affects their tax deduction.
Correct. Well, this is what governs it. What the money managers do is how much income they actually get from the pooled income fund.
Right. To me, that's a huge issue. I'm getting two things. That's a very low rate, so we should be able to accomplish that,
Correct.
Hopefully. And then the deduction by age is going to be, I think some of this is huge numbers.
There's some very big numbers here. And so, someone might have a pro athlete. Maybe they're in their twilight of their career, in their 30s, or making millions of dollars. They might consider doing something like this in order to take away some of that income tax liability that they're incurring with the high salaries that they're making.
Mm-hmm. This is a huge tax thing. Is this tough to learn?
This would be a little more in the complicated area of charitable planning.
Okay, so what we might do is if we get enough traffic on this show, we may have you come back and do a complete workshop. No commercials, just walk us through this, and I mean step by step.
Sure.
And get into the minutia of it all.
Yeah, it is. Now, some of the applications here is often when a person comes to us and they have already sold something, that the tax liability is under the bridge. Maybe they sell it in the beginning part of the year and we're sitting in third quarter and they have a large tax liability. Well, due to the size of these deductions, they can set up a pooled income fund, receive a large income tax deduction. They'll take a significant amount of the sting away from that tax liability they incurred earlier in the year.
But you just said at the front end I had my sale or whatever I did to accumulate a tax. Yeah. Now I'm sitting at the end of the third quarter. So what kind of lead time do I do if I find a client that has made a mistake in their planning of whatever they sold?
Right.
What kind of lead time do I have to have? Is it a whole quarter? Or
I would say give it several months. So you want to get to start this in even third quarter, start working on this and making sure it makes sense for them to do. And they have to be charitably inclined to do that. You can also work how, depending on how the money is made or how the investment performs and what kind of investment style you're doing, you can dictate what kind of income they're going to be getting. So if you have a low income producing asset, maybe while they're still working, great. But as soon as that asset, let's say when the income stops, you can change the asset allocation here and then start generating income for retirement for the client.
So with my low generating income, once that's gone or whatever I'm using for, I can switch over to this.
So, you can inside here. So you set this up, get the income tax deduction. While the working years is going on, have an investment strategy that's not emphasis on higher income. Maybe it's lower income, more of a passive strategy, if you will. And then when your client gets to retirement or the income ceases from the other source, is readjust the investment strategy in the pooled income fund for higher income during retirement years, say. Another thing we kind of hit on all the shows so far has been kind of reoccurring theme is the Roth Conversions. Is saying that if someone sets up a charitable strategy, a pooled income fund, a charitable remainder trust, a donor advised fund, they get a large income tax deduction, and let's say they can't use it all. Maybe they have such a high deduction, such as in a pooled income fund, that they're getting to the 6th year, the current year plus 5, and they still have tax deductions on the table. This is a great way to convert to Roth and use up the rest of that deduction. I'd like to see my clients be able to use 100% of their deduction that they've earned throughout the 5 years.
And most clients are going to have some qualified money.
Yes, most will. Or they might have a non-qualified annuity, or there might be something there that they have that they can realize gain on. There's many possibilities. This is big, especially if you have a client who's not insurable or just doesn't like insurance, and no matter what you tell them, they're not going to do the insurance. And we all know there's people out there like that. You can use this in multiple generations. So I have clients down in Fort Myers, Florida. They're in their 80s. They have children in their 50s. They have plenty of life insurance, but they want to provide their kids a lifetime of income just in case they're not financially wise with their inheritance. So this couple in their 80s are going to put the son and daughter, who are in their mid-50s to later 50s, on as the successive income beneficiary. When mom and dad pass away, that income will move over to the kids. Now, there's some estate tax complications, but that's something we can work around, we know about, that we can work through.
A huge idea, and I love the aspect of buying income for the next generation just to make sure that they don't have any financial issues.
Yeah, exactly, a safety net.
Well, for more information on charitable giving with pooled income funds, just click on the landing page address in the video description. And for more information on all our shows, seminars, and workshops, you can follow us out on our social media or visit us out on our webpage. I'm Steve Savant. We'll see you next time on Thought Leaders. And remember, keep thinking outside the box.